you can go with the flow when it comes to investing. Continue to deal with the income outage of bonds. Or discover the power of dividends with higher-yielding sectors of the S&P 500. Like utilities, XLU can transmit the benefits of equity income to your portfolio. With liquidity, all-day tradability, and transparency. Ready to plug into a different source for income? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
I'm DeLegge with ETFguide. Welcome to Marketplace Minute. When it comes to properly assessing Chinese stocks, are financial experts bad or just blind? Here's what they've been saying about Chinese stocks. Jeff Reeves of MarketWatch on November 11th, 2013, it's time to buy China. Here's what Motley Fool said on November 18th of 2013, Chinese stocks, huge growth and room for more. Here's what Bloomberg had to say on November 26, 2013. Goldman says buy China, Russia stocks on valuation and reform. Oh my goodness, how wrong could they be? Here's Bloomberg again. Goldman predicts biggest China 8 share advance since 2009. That was on December 2nd of 2013. Now, the one thing all of these financial opinions have in common, ladies and gentlemen, is that they've been dead wrong. In fact, while all of these experts have been trumpeting Chinese stocks on cheap valuations and reforms and other cute theories. Actually, we've been alerting our viewers as well as subscribers at ETFguide to do the exact opposite. In fact, here's a time-stamped alert that we gave to our subscribers. On December 6th of 2013, we issued a buy alert on the ProShares Ultra FTSE China ETF, that's ticker symbol FXP, which aims for double daily opposite performance to Chinese stocks. We also had this to say, quote, from our vantage point, the prudent investor has two better choices. Number one, aggressively short Chinese equities, or number two, to aggressively avoid them. That means if you're the least bit bullish on Chinese stocks, you best wait for lower prices before plowing in for the long run. End of quote. And that's what we said on December 6th, 2013. That's a timestamp trade on FXP. It's been a great trade. It's been the right place to be in terms of Chinese stocks. The People's Bank of China, also known as the PBOC, is trying to keep its financial system from imploding. And they've resorted to these novice tactics like issuing press releases on Saturday night while everyone's at dinner or at the movies. I mean, these are rookie tactics for an institution that you would expect a lot more of. Also, you may not know this, China is a global leader in bribery and in corruption and now ranks 80th among 177 countries. In fact, China ranks ahead of Brazil, India, Russia, Turkey, and even pathetic Venezuela in terms of bribery and corruption. That's not exactly a sign of bullish sign. Also, the upcoming IPO of Alibaba, which is expected to give this Chinese-based e-commerce giant a market size of $140 billion, is just another well-crafted distraction. So China's unfolding credit crisis is just getting started. It's in the first inning. It hasn't hit full stride. And there's scant evidence right now in the market that capitulation selling has hit Chinese stocks. So when we see that capitulation selling, that's a sign of an imminent bottom. That's the buy signal that it's time to go long. We haven't seen that moment. For patient investors, for investors that are opportunistic, that moment will come. And when it does, that's when you want to pounce. Until then, Chinese stocks are a classic value trap. I'm DeLegge with ETFguide. Thanks for watching Marketplace Minute.